Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a very happy Sunday to you. I want to make sure you have the sincere and actionable ideas that you need to defuse the ticking time bomb in your retirement. I'm talking about the tax time bomb. Truthfully, it's a real issue. And joining us, as always, in the studio on a Sunday morning is David. So, David, do you think this tax time bomb sounds a little bit dramatic, or maybe frame up what this tax time bomb is that we're alluding to?
Well, these retirement accounts aren't tax-free. They're tax deferred. So eventually we're going to have to pay the piper. And I think there's this maybe old saying out there that when everybody retires, they're automatically going to be in a lower tax bracket. And I think for a lot of folks in the middle class, that's not what we see in real life. So we should break this down and talk about real strategies to help keep more of what you've socked away.
So wait, Dave, what you're telling me is these retirement accounts, and maybe it's so obvious that the clue is deceptive. The most obvious clue is deceptive. So what you're saying is once we age out appropriately past the age of 59 and a half, not all these retirement accounts are tax-free. Is that what I caught?
100%, right? You're going to hit a certain age. Maybe it's your required minimum distributions. Now the government decides that it's your turn to start pulling money out so they can get their revenue. And sometimes those RMDs can push you into a higher income tax bracket, which could mean your Social Security benefits are taxable at a higher rate, or perhaps your Medicare premiums are now more expensive than what your neighbor pays.
So wait a second. You're telling me that someone's Medicare premiums could be more than their neighbors? And what 100. Is it that influences and controls that?
Your taxable income, right? And I think a lot of this is you don't know it up until you know it. So you have 1 year where your taxable income is higher, and then you get a letter from Medicare, and the letter says, hey, just wanted to give you a heads up. Next year, you're going to pay a surcharge. So on top of what you're already paying, we're going to charge you a little bit more because we, the government, think that you can afford to pay more, even though you have the same benefit as your friend down the street.
All right. So the reality, David, is let's frame this up. We're talking about the ticking time bomb that lurks in every future retiree and current retiree's portfolio. And David, so many people are solely focused on growing their investments. But I think the message we're all hearing again this morning is they should be paying just as much attention to not just the growth of their investments, but how much of that investment balance they're going to be able to keep.
That's exactly right. We've met with plenty of people who've done a fantastic job saving. The problem is they've got plenty of money, but they haven't planned on how they're going to start withdrawing it from their accounts efficiently. The goal isn't just a good return irrespective of taxes. It's to really maximize what stays in your pocket after you pay the Fed, or in certain cases, the Fed and your state of residence.
So let's take that into, a real life example. So what are some of the biggest mistakes that we see as practitioners relative to this topic of the, ticking time bomb that is taxes for retirement?
I would say a few stand out. Number one is people wait until they're forced to take RMDs before thinking about taxes. They withdraw money from the wrong accounts in the wrong order, not necessarily considering strategies like Roth conversions during lower income years. And a lot of retirees unintentionally trigger those higher Medicare premiums because they don't realize how different income sources affect their tax picture. Each decision might seem very, very small, but together they can cost someone tens of thousands of dollars over the course of their retirement.
So let's be clear about something. We're here to really give people solutions. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. We want to help you diffuse the ticking time bomb that is TIR, taxes in retirement. So, David, I appreciate you saying those things. Let's go into the solution. What's the solution?
Yeah, it's about being proactive, I think, instead of reactive, right? It's not something that people have experience with, right? Because you only retire one time, hopefully. So I think what people should be asking themselves are like the following. Which account should I withdraw from first? And what I mean by that is lots of families have put money away in 401ks and IRAs, brokerage accounts, trust accounts, Roth IRAs. There should be a liquidation order for those accounts. Question number 2 is, should you be converting some of that traditional IRA money to Roth? And then we think about how we can reduce these lifetime taxes instead of just thinking like, what's next year's tax bill going to look like? Because we want to spread this income over multiple years, but we want to do it in the most efficient way possible. So that's how we have to start thinking about this. And I think the key is these aren't really just problems for folks that have done an awesome job saving. It's not an ultra wealthy problem. A lot of these things affect folks that just had good salaries, but did an awesome job saving capital. And you, again, like I said before, I think the challenge for a lot of folks is you don't know it up until you get that letter from Medicare. And that's not something that you want to open up and read and be disappointed about.
All right, so let's be clear. I think all of these things apply not just to wealthy retirees. David, I would argue they probably apply to everybody.
100%.
Yeah. So I think that's really good advice. So as we talk about this, here's what I want. Everybody listening, don't wait until the IRS tells you it's time to take money out of your retirement accounts before you start thinking about taxes. By then, many of your best planning days and best planning years, they're already going to be behind you. And the difference between a good retirement and a great retirement isn't how much money you've accumulated, it's how much money you keep after taxes. That's why every retiree or anyone within 5 to 10 years of retirement should have a retirement tax strategy. You can't afford just to have an investment strategy. So I want you to take advantage of a complimentary retirement tax analysis with us today. We'll review your IRAs, your 401ks, all of your opportunities, how you're going to integrate your Social Security, your retiree health care. This is a free retirement tax analysis, no obligation. It's simply an opportunity for you to understand where you stand and the strategies that could benefit your family's retirement. So you want to schedule that complimentary retirement tax analysis today, 833-964-PLAN. That's 833-964-PLAN, or go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Because the sooner you start planning, the more options you're going to have. And I repeat, do not let taxes take a bigger bite out of your retirement than necessary.
So, Craig, let's use a real life example. I was talking with someone the other day, and they had called up. It was a referral from an existing client. I said, what was the catalyst to get you to call? And she's like, well, we just retired, and the issue we ran into was our old advisor had told us that we need to do all these Roth conversions, but the end result of doing all these Roth conversions just put us in one of the highest tax brackets we've ever been in. And then all of a sudden now we have to pay for our Medicare. And that caught me off guard because normally when we're doing these Roth conversions in conjunction with retirement, what we're trying to take advantage of is that arbitrage between like a dual income household being in a 24 or 32% bracket and then maybe dropping down once the salary comes off the table. So can you just give a quick example of how we might want to maximize up to the existing marginal tax rate to maximize maybe the 12% or the 22?
Yeah, listen, you have to make sure you're paying attention to the tax arbitrage. That is the marginal tax brackets. David just gave everybody the numbers. Know how to fill either through withdrawal or through conversion, your 10 and 12% marginal tax rate. Because odds are you got to be doing that every single year, because during your earning years, you are probably contributing to those accounts at a 22, 24, 32% rate. So the ability to harvest it at 10 or 12, that's guaranteed tax arbitrage. And that could be in a low income year. It could be something unique as a business owner because of net operating losses that you carried forward. It could be as simple as the valley of retirement. You had just retired, and as a result of just retiring, you're actually going to print the lowest 1040 you've printed in decades. Those are all opportunities. And David, I feel bad. I'm happy you heard from that listener who did a Roth conversion. But conversions aren't an event, David. Conversions are a process. And that's why our listeners need to work with advisors that integrate the tax planning with the retirement cash flow modeling, supported by a very robust institutional investment program under a strict fee-only fiduciary standard. That is VestGen Wealth Partners. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. Getretiredstayretired.com. Stay tuned. We're going to talk about the indexing that you need that you didn't know existed.
You want more in the know radio? You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560. The Answer. Welcome back. Here's more with Craig.
Hey, listen, I got to tell you, this has been one of the fastest growing investment strategies that almost all investors have never heard of. But once you do, I'm going to reveal it here. You often wonder why no one told you about it years ago. It's called custom direct indexing. And if you've got money in taxable investment accounts, not your IRA or 401k, but your brokerage account, you gotta stay tuned. So David, break this down, because you know what? Every once in a while, technology creates disruption. Disruption challenges entrenched ways of thinking. And you know what it does? It doesn't create fads. It creates actionable secular ways to implement with more efficacy with clients. And I think that's exactly what direct indexing is. So David, do you think what we do at VestGen Wealth Partners, which moves beyond direct indexing, it's custom direct indexing, fad or secular strategy?
No, not at all. I mean, I think this is one of the most important advancements in portfolio management that we've had in decades. And here's why. For a long time, investors really only had two choices. Option one is they could buy individual stocks, or they could buy a mutual fund or ETF that owned 100 different stocks. To me, direct indexing is combining the best of both worlds. You get the broad diversification of owning an ETF or an index fund, but instead of owning one investment, you own the individual companies inside the index. And that simple difference of owning the individual companies in the index creates all the opportunities that don't exist with traditional funds. And that opportunity set is tax efficiency.
Tax efficiency and customization. So let me make that simple. You own an S&P 500 index fund. You're saying, how is direct indexing different? I'm going to compare it to something I love. I'm from Chicago, so are our listeners. Think of your favorite pizza restaurant. When you order a pizza, you get whatever toppings are already on it. You can't really separate them. That's your mutual fund or ETF. Direct indexing is like receiving every topic separate, right? Every topping separate. You can add more pepperoni. You can take away the sausage. You can add green onions or green peppers. Take away this, take away that. And that's what direct indexing is doing. And David, that pizza analogy speaks to me. One, because I love pizza, especially deep dish. But two, for people who have been worried about the single stock concentration risk of some large IPOs that are coming to market, how at VestGen are we using custom direct indexing to give them the exposure they want, but weed out the large cap weighting problem that we all know is coming?
Yeah, so I'll give you a real life example because there's lots of benefits, but your question is specific to, do I want exposure to a specific company or not? So one of the things they say on TV is if you want to invest in Elon Musk's new company, don't worry, because if you participate in a 401k, you're probably going to own it by default anyway, because that stock is going to be pushed into the indice. But there are some investors out there that said, you know what, I would prefer not to own it. Well, that's what custom indexing does. Custom indexing allows you to replicate an index of your choosing. But if you would prefer not to own one particular stock or maybe several particular stocks in an index, you can have them removed. Or on the flip side, if you might want to overweight some of those stocks, you have that ability too. So we're really getting a deep dive in personalizing portfolios to a family's value system or their specific investment preferences. And that's on top of all of the very unique tax benefits that are getting as well.
And we're going to go there too, because I think people, David, are saying, hey, listen, this custom indexing from VestGen Wealth Partners sounds interesting, but again, broad-based, how's it helping me? Simple. Tax efficiency, customization, risk management, and greater control. And let's go right into those taxes, because that's usually where investors see the biggest benefit. It's always about the tax leverage. So imagine we've got two investors, David, each have $1 million taxable investment portfolio. One investor owns the index fund. The other owns the individual stocks that make up that indexing fund. Now, David, imagine the index itself is up 10%. If you own the index fund or you own the custom index from VestGen, both will be up 10%. Agreed?
Agreed.
But understand that in a broad-based index, there are so many stocks. There's going to be companies that are up 35%. There could be companies that are down 20%. There could be companies that are flat. And when you own not the index, but you own the individual names of the index, you get the opportunity selectively throughout the year to harvest the losses on the stocks that temporarily declined while keeping your overall market exposure largely intact. And those harvested losses are going to offset your current year. Those harvested losses are going to offset your future capital gains. And to a degree, they can be written right off of page 1 of your 1040. So listen, you might make double-digit returns, but actually get capital losses, which are tax deductions on your return. That is the single biggest advantage.
So what you're essentially doing is you're taking the market volatility and starting to use it as a resource or a benefit for your portfolio, as opposed to shying away from it.
That's exactly it. VIX or volatility is now a tool. VIX and volatility, when you have custom direct indexing from VestGen, isn't something to fear. It's too many investors are panicking, moving markets around. We see opportunity. Some of our best tax planning happens during volatile markets. When we had the oil shock in March of 2026, when we had the tariff tantrums in March of 25. And it's just so important that we do this, and we do it very well at VestGen Wealth Partners. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretired.stayretired.com.
So due to the number of securities, right? Because we're talking about owning a large basket of stocks to mimic an index on a pre-tax basis, investors aren't doing this themselves, right? How does the execution actually happen behind the scenes? Pull away the curtains and give us a little bit of an idea of how that works.
Well, yeah, the execution, David, is very systematic. It's disciplined. It's repeatable. It makes it non-emotional, and it's done through technology. See, again, at VestGen Wealth Partners, we're a boutique firm, and that boutique firm provides you the multifamily office experience that you need of all these different financial disciplines. But we've got the institutional horsepower that the solo advisor cannot do on their own. So, David, courtesy of technology shouldn't be feared. Technology enhances the human experience, and that's leading to better after-tax investment results for clients of VestGen Wealth Partners who are doing custom direct indexing.
So we mentioned one of the benefits of custom indexing using a specific stock example. So if a client maybe wanted to overweight a particular holding, or perhaps they said, you know what, for specific reasons, I would prefer not to own any shares of that particular company. But I think another thing that's becoming more popular is folks want portfolios that reflect their value system. When we talk about portfolios that reflect their value system, Craig, what are we talking about specifically? Give us an example of some of those value systems.
It could be as simple as someone not wanting tobacco. It could be as very direct and concentrated as someone wanting to honor the concept of pro-life through their investment portfolio. And custom direct indexing allows you to easily exclude and screen out those individual companies or sectors that are in direct violation to what's important about money to you and your family. So I think we come back to the most important thing. If you have after-tax investments and you want to be doing better, you deserve and should consider working with VestGen Wealth Partners to create a custom direct indexing solution for you. The 1970s are over, people. The 1990s was fun, but that's also in the rearview mirror. It's 2026, and you need to work with advisors and firms who are harvesting technology to give you the asymmetrical performance of the stock index, deliver the after-tax results that you demand and deserve, and provide you the customization to eliminate the duplication and violations that you don't want in your portfolio. We invite you to learn more. 833-964-PLAN. That's 833-964-PLAN. Go out to that website, getretired.stayretired.com. That's getretired.stayretired.com.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
I wanted to do a follow-up on the custom direct indexing that we talked about in that last segment, the B block. David, what's the executive summary again? And what are some of the additional takeaways that we didn't get to talk about in a broad-based spectrum?
I think the key is the technology is moving so quickly, and it's getting more advanced tools to Main Street every day. And that's something that should be embraced. So if you're still using traditional mutual funds, or in certain cases, ETFs, we're here to tell you that there's perhaps a better way to invest for taxable brokerage accounts. But very specifically, I think what we should follow up on, Craig, with folks is there are a few different situations where direct indexing or custom index can make a huge difference. Number one It's for business owners. Give us an example, Craig, of how a business owner might benefit from deploying a custom indexing strategy before they have a liquidity event.
If you're a business owner who's eventually going to get your business monetized, you know I'm talking about a multiple of revenue, multiple of EBITDA, then you know you need to focus on mitigating that capital gain that you're going to have. Establishing a custom direct index account today is going to allow you to start building up. Even though you're making money, you're going to be able to build up those capital losses that are going to sit in your capital loss piggy bank that carry over from year to year, so that when you have the liquidity event of the business sale, you can mitigate the taxes on the business sale via your capital losses that are in the piggy bank. And when I talk about custom direct indexing, it's also about how fast do you want to drive? Do you want to drive 130-30? Do you want to drive 145-45? How long and how short do you go? That's what I call custom direct indexing on steroids. So if you have a liquidity event of some type that's going to be happening inside the next 12 to 48 months, really consider contacting us at VestGen Wealth Partners so we can show you how we can graduate from VestGen's custom direct indexing to what I deem to be VestGen's custom direct indexing on steroids to accomplish the goals of making you money in the market, but offsetting the capital gains on your business liquidity event that's pending.
Now, let's give our listeners one more example that I think is applicable to lots of different folks listening today, which is folks with concentrated positions or folks that have been participating in this great stock market we've had where they have large, embedded, unrealized capital gains. They want to rebalance their portfolio, but they're nervous that if they sell and take profits, they're going to have a huge tax bill. That's another great application for direct indexing. If you want an approach to slowly help you wind down concentrated positions in portfolio, think AI stocks that have done really well, then get the process started now. And the very unique thing about custom indexing at VestGen is you get a personalized capital gains budget that reflects your family's 1040, meaning we can set a cap on how many capital gains you realize, and we'll work within that cap on a monthly basis to slowly wind down positions. So if you're out there thinking, hey, this is a great market, I want to take some profits, sell into market strength, but I'm nervous about the taxes, we have a solution that's very applicable to everybody. But for those that are worried about capital gains, we are the right shop to call. So Craig, I was thinking about this the other day. And it relates to what I just mentioned, which is the market's gone up. People might want to look to take some profits out of the markets. And one of the reasons they might want to take some profits is they're starting to learn about what I call sequence of return risk. Now, what I think is interesting is sequence of return risk is not some new risk that's there today. That's a risk that everybody is trying to avoid long term. It's always there. And to me, sequence of return risk is, are we retiring into an upward trending market or are we retiring into a downward trending market? Because at the surface, if I told you that two retirees both earned an average annual return of 7% over the next 20 years, you would assume that they would just end up in the exact same financial position. But the answer is, that's not necessarily true. What matters is what that journey might look like to get to that average rate of return of 7%. But what are some of the ways, and give us maybe a real life example of A, what does bad timing look like in retirement? And then B, how do we solve for it?
Yeah, David, I mean, the visualization I've used for the sequence of return risk that you just opened up the can on is, hey, it's the order through which you experience returns early in retirement. Think about this as like being a rock climber. You're climbing a mountain. If you stumble the first few steps, you usually recover and keep climbing. But if you're climbing a mountain and you stumble near the edge of a cliff, The consequences, they are dire. They are that much greater. And retirement investing works in an eerily similar way. During your working years, I would argue market downturns could actually be your friend, because if you're buying into the market with your monthly paychecks, you're buying investments at lower prices. But once you're retired, everything you have is everything you're ever going to have. Retirement just changes everything, because now you're not adding money, you're withdrawing money. If the market experiences significant declines during the first several years of retirement, while you're simultaneously taking income from your portfolio, now you're selling investments when prices are depressed. Those shares that you sold are gone forever. And even though the market will eventually recover, you own fewer shares, making it that much harder, if not impossible, for your portfolio to bounce back. That is sequence of return risk in its nutshell, David.
So a lot of people are thinking about that right now. They're thinking, hey, this market's had a good run. I'm going to be retiring the next couple of years. What's the hedge? Because some people are just saying, hey, you know what? Like, let's just sell. Stocks are high. But I think at VestGen, we approach it a little bit differently. What we're doing here is we're trying to, reverse engineer the cash flow, right? So how would you work with the family to start reverse engineering the cash flow so that they did want to take some profits to protect so they don't go over that proverbial cliff in the first 2 years of retirement? What's the math look like? How do they start thinking about that?
Well, we start with the math, David. It's not about what you want, it's about what you need. And then once we know what someone needs, then we can benchmark that relative to what the portfolio can give. And hopefully that aligns with what it is that people want. If it doesn't, we got to make some changes to get there. And that means creating a diversified set of income streams. That means interest, dividends, payments. There are different tools that you and I talk about on this radio program all the time that can be integrated together to accomplish the reserve and income needs that somebody needs. Because remember, if we're living off of cash flow reserve accounts or we're living off of portfolio income, then we will never, ever, ever be put in a position to reduce or sell any shares of equity when market forces go against us. And that is the single biggest key to curing sequence of return risk. So if you're listening and you're now saying, wait a second, there's a new world, custom direct indexing. I'm a business owner. These guys get me. It's all about the income taxes. You too are worried that after years of market run-up, you could be retiring into declining markets. How is your goals-based financial plan that your advisor probably does for you, how is that specifically addressing sequence of return risk? Odds are it's not. And that's why you got to talk to your friends at VestGen Wealth Partners. So give us a call, 833-964-PLAN. That's 833-964-PLAN. Go out to our website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com, because you too deserve not to survive retirement. We want you to thrive in retirement so that you worry less, live more, and get everything that you've worked a lifetime for.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
We've got to discuss why investors need private markets, not just public markets, to succeed in today's new world economy. I mean, listen, if you're investing for retirement, chances are you own mutual funds, ETFs, individual stocks. But what if I told you the truth? That a lot of the biggest opportunities today aren't even available in the stock market. David, we've been educating clients through the platform of this radio show that relying solely on publicly traded investments might not be enough anymore. I mean, maybe some people think that's a bold statement, but is it?
I don't think it's bold. I think, is it a one size fits all? Certainly not. But I think we've seen a shift, right? We've seen a shift that business owners who have built innovative business models, products, and strategies aren't going to market as quickly. And quite frankly, I think they don't have to, right? Because if you own a technology company, Craig, with a fantastic idea, you'll probably get a phone call one day from New York. And there's someone on the other end of the line from a PE firm that says, hey, look, we've been reading about you. We've been using your product. We think you've got something really great here. How about instead of going an IPO, instead of going public now, we'll write you a very large check. You can continue to run your company as you've been doing, but we'll get you wealthy today. No IPO required. And that doesn't mean that that company might not eventually go public. But I think what it does mean is the timeline to go public might be extended. As an investor, if you're looking to perhaps get in on that idea, you either have to wait for 5-10 years longer, or you have to find a different avenue to participate. And I think in certain cases, that other avenue to participate is in the private markets.
I think it really is, David, because again, we think about how businesses are built today. Years ago, companies went public very early. Now, companies stay private 10, 15, sometimes 20 years, which is oftentimes where the fastest growth occurs. And when we talk about this concept of private markets, it can be private real estate. It can be private infrastructure. It can be private energy projects. It could be private lending, private credit. There's so many different takeaways. And remember, it's flattering to imitate institutional investors, pension funds, endowments, big family offices. They've been investing in private markets for decades. So the question isn't whether or not they're investing there. The question is, why aren't individual investors? And I think a lot of that's because people assume private investments are only for the ultra wealthy. And I'm here to say that used to be true. If you're a qualified investor, you have more access to opportunity today than you did in the past because technology and other items have, once again, democratized access. And you deserve to know that the investment landscape has, in fact, evolved. So you now have access to institutional quality investment strategies that at one point in time were only reserved for the largest investors. There's so much money in this space, and that's why access is there, because it comes down to what David said. Businesses are built differently. And investors are probably wondering, oh my gosh, am I late to the party? No, this isn't about chasing returns. It's about protection. It's about diversification. It's about the fact that public stocks, especially with the proliferation of ETFs today, they all tend to move together. They all move as one during periods of market stress. And private investments are going to oftentimes give you the opportunity to have a different response to different economic forces. And you know what that does, David? That can smooth out the volatility over time. And if we're smoothing out the volatility over time, we're helping to solve for sequence of return risk that we just talked about. So, David, are private markets replacing publicly traded markets?
Absolutely not. This isn't an either or conversation. I think it's just about building a better, more what I would call a durable portfolio. Public markets remain incredibly important. That's likely going to be the core of most investors' portfolio. But I think successful investors today are starting to think about combining public investments with very carefully curated, selected private investments. Think about it like building a championship sports teams. You don't win with offense alone. You don't win with only defense. You build a complete roster. And the same thing applies to investing is you have to have things that move in different directions. And one of my favorite sayings about investing is if everything's always moving in the same direction, are you really diversified? And the answer to that is probably not. It might feel good when the markets go up, but when the markets eventually go down, then investors, I think, are wanting a little bit more and need to be thinking about it differently. So, Craig, for listeners out there, who is the right fit? Who should be thinking about this?
I think it's just anyone who's got more significant retirement savings that has a desire to truly understand where institutional investors and institutional capital have and are placing their money. Now, I mean, not every investment's appropriate for every investor, David. We know that. But here's the challenge I give to the listening audience, the way you said it. If your entire investment portfolio can be found on your brokerage statement with stock ticker symbols, you're only seeing part of today's investment universe. And that means this is worth exploring. The other thing I tell people is this. Here's another question. Do you know how much of your portfolio is invested like a large endowment or pension fund? And we realize that endowments and pension funds have infinite time horizons. We as humans have finite time horizons, but we can learn and glimpse from what it is they're doing. And if the largest institutional investors have spent decades in private markets, shouldn't we seek to understand why? And that's why I want to give investors the opportunity to learn more. So I want you to reach out to us and let us show how you too can go beyond Wall Street and understand why private markets are changing and have changed the way wealth is built. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. You know what? Be specific. We offer a private markets portfolio review so you can see how VestGen Wealth Partners is using its institutional presence to go ahead and deliver not just what you heard today, the custom indexing, not just how we are diffusing the ticking tax time bomb in retirement, but how we're solving for sequence of return risk and where private markets can pick up, where public markets are leaving off so that you too can worry less and live more. David, what else do we need to know? Or give us some samples of how infrastructure or HALO or HELP acronyms that you've talked about on the radio can be deployed for people today.
Yeah, well, I think you hit on two very important things. The first is, I think good stewards of capital understand that this is an endeavor in education, and whether or not private markets are right for you, I think everybody deserves to learn what's available and make their own decision of whether or not that's something they want to participate in. But if you've never had the opportunity to learn, how do you know? Maybe that is something you should include. Or maybe after learning, you say, hey, that's a great idea, but it's not for me. So I think that's number one takeaway. I think the second takeaway is what we're talking about the last year, which is markets continue to move higher. People get a little bit nervous about valuations. And if you're looking to carve off and take some profits from publicly traded companies, this is one tool that you can have in your portfolio to kind of stay in the game, but perhaps improve your risk-adjusted returns moving forward.
833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. We want you to start getting improvement. It can be improvement at the margins. Experience what a multifamily office really can deliver to your family by having multiple disciplines all under one roof, working for the common good, which is you, our clients at VestGen. More to come. Craig and David Bolanos. This is In the Know Radio on AM 560.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
I think the message from the entirety of today is that VestGen Wealth Partners, we believe that successful investing today requires more than simply owning stocks and bonds. That's why we've built an investment philosophy designed for today's economy, not yesterday's economy. We see the changes the Fed Chair Warsh is making because he too knows the changes that are so compelling. They're not just underfoot, they've already occurred. That's why President Trump appointed him. And at VestGen Wealth Partners, we're focusing on real return investing because we know what it means. You can't spend returns. You don't spend percentages. You need to protect purchasing power from inflation. That's why we're incorporating our real return strategies. That's why we incorporate private market investments to give people access beyond Wall Street so you can have the enhanced portfolio diversification that we discussed today. And a big part of financial planning and getting retired and staying retired is having retirement income strategies that address the sequence of return risk, because a poorly timed market downturn early in your retirement years could have a lasting impact on the entirety of your financial future. And remember, it's custom direct indexing that can improve after-tax returns by harvesting losses while maintaining the market exposure that you want. It's that customization. And all of these, they're not isolated strategies. Everything that I just mentioned is integrated into a comprehensive wealth management approach that's designed to help you grow, preserve, and distribute your wealth more efficiently. That's what VestGen Wealth Partners Vision Path process is all about. And I know you want to see how these strategies can fit into your financial plan. So give us a call today at 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. Take that complimentary portfolio stress test and investment strategy review so you too can move from good to great. Because when you move from good to great, the worries start to slip away, which allows you to live more. Because at VestGen Wealth Partners, we're not just helping clients invest for the next quarter, we're helping you get retired and stay retired over the next 20 to 30 years. You've been listening to Craig and David Bolanos. This is In the Know with VestGen Wealth Partners on your favorite station, the station with all the answers. That's why we call this In the Know Radio with AM 560, The Answer.